Hello students, let us today start ratio analysis. This is also a very important chapter and a lot of theory comes in this. And so before starting, let us understand what is ratio. So ratio basically is a comparison of two figures, two amounts or two quantities, whatever it is, and expressing it as a fraction. So what will you in accounts, what will you compare? So basically, when the ultimate statement that comes out from the company's accounting is the financial statements. You get a trading and profit and loss account and balance sheet. So the figures that are shown in that is the status of your all-round performance throughout the year. Okay, so you need to know how your company has been performing, what is its performance compared to last year. So all these things cannot be judged just by seeing the profit or the balance sheet. So this ratio comes to help here. So ratio is what? It is a mathematical relationship between two financial figures taken from the company's financial statements. Okay, so this ratio helps to analyze a company's performance, the liquidity, the solvency, the profitability. All these things can be judged from the ratio. So since financial statements are the main source of information for users, so who are the users? The users are basically those persons, the owner, first of all, the owner, the employees, the banks or financial institution, the investors, the public at large. All these people might require that how the business is performing, they should be knowing about it. So, to gather crucial information for evaluating the company's financial performance, users rely on both most recent as well as historic financial statements, and determining whether a company's financial status is improving or deteriorating can be aided by facts or information so gathered during the analysis. So ratio is a benchmark. It helps to compare your performances over the years so that you are able to take decisions regarding the future strategy of your business. Now let me explain with the help of a pictorial diagram. See, this is a medicine shop and this is a stationery shop. So let us name it A and B. So the medicine shop makes a profit of 40,000 in a year and the stationery shop is earning 60,000. So what happens in the first instance, we see that stationery shop is in a better position, that it's earning more profit. So now comes the question of ratios. How does it help? Now try to understand that the capital introduced, we'll find out how much he has introduced into this business. So the medicine shop wala, he has introduced 1 lakh. And the stationery shop, he has introduced 2 lakh, invested this much in business. So now you find out a return of ROI, means return on this amount invested. So what is the percentage? So 40,000 out of 1 lakh as a percentage into 100 is equal to 40%. He is earning 40%. And on the other hand, the stationery shop wala, he is earning 60,000 divided by 2 lakh into 100, that is 30%. So what happens? The scenario changes automatically. So now the medicine shop is earning comparatively more than the stationery one. So this ratio helps to understand that A has earned rupees 40 for 100 rupees invested, whereas B has earned 30 rupees for 100 rupees invested. So who is in a better position now? So the significance only when expressed in relation to a asset can give you the actual picture of the performance of the business. So let us now understand the features. So first one is, it is one of the tools of measuring the financial performance of the organization. Okay. Second is, it is a comparative analysis between two factors. We are taking two factors, so this helps to make the comparison. Third is, business performance can be measured by use of ratios, helps analyze the company's strength and weaknesses. Then comes the fourth, it must be interpreted against some standard. These ratios also later on we will study. These ratios have a ideal ratio also fixed. Some of the ratios have certain ideal standards set. So if the business is within that standard, that means the business is performing well and need not make much improvement. The fifth is, apart from the absolute profit figures, the management might find a need of relative data information about the variables. So only seeing the profit will not give you the right picture. Sixth is, it evaluates the financial condition and the purpose of the firm through various yardsticks. And this tool is useful for all the various stakeholders of the company, that is the users, like the shareholders, the bankers, the creditors, the lenders, investors, and the government also. Okay. So now the usefulness, how this ratio is useful, like it helps in simplification of data, helps in disclosing the operational efficiency. It is a benchmark for comparison. It helps in planning for your future, managerial tool, analyzing the financial statement on the basis of ratio, and scanning device. Now, limitations. So we are doing a lot of theory because your paper consists of theory as well as practical. So you should not ignore the theory portion because a lot of MCQs also comes in this. So go through them later on. I am trying to do it in a fast manner. That is, first limitation is, it depends on the past data, which in itself serves as a limiting factor. It may not represent the correct picture of business. Also, false accounting data gives false ratios. So, accounting ratios are calculated on the basis of data given in the profit and loss and balance sheet. So, profit and loss and balance sheet might also have some figures which might be manipulative, or it might be overvalued. Usually, the closing stock may be overvalued. So, it will not show the exact picture. So comparison is not possible if different firms adopt different accounting policies. This is also a problem because every business has a different policy. I mean, not every business will be following different policies, but there are different policies which may be followed by the businesses. Like someone might be following the straight line method for depreciation, someone might be following the written down value method. Someone might value their inventory under LIFO method, and otherwise there is a FIFO method also. Someone might follow the cash basis and otherwise the mercantile basis. So there are different policies which will be followed. So if you compare them, the ratios between them, then it will not show the exact picture. So ratio analysis becomes less effective due to price level changes. That is also a factor because prices may not be same throughout. So how can you compare that also? Therefore, they will only they'll be only as correct as the accounting data on which they are based. So the data, on the basis of data only the ratios are calculated. So only accounting information is used while analyzing and interpreting the results of ratio analysis. Okay. In taking corrective action, the management might concentrate more on improving the ratio rather than solving the major reason behind such adverse conditions. Also, it is not necessary when two items are compared that due to the items in question leads to changes in output. There may be other reasons also. So please go through your theory part. Now we discuss about the categories of ratios that we are going to study. They are liquidity ratios, solvency ratio, profitability ratio, and turnover ratio. We are going to study these. So the first and foremost, which is very common, that is the liquidity ratio. So under liquidity ratio comes the current ratio, the quick ratio, the cash ratio, etc. So as the name suggests, like liquidity ratio is required to find out whether this company, in case of financial crisis, whether the company can utilize the current asset, can sell it off and repay its debts or not. Okay, solvency ratio, this ratio reveals how much amount in a business has been invested by proprietors and how much by the outsiders. Okay, so under this category comes debt equity ratio, total asset to debt equity ratio, proprietary ratio, interest coverage ratio, etc. Now, profitability ratio, to find out about the profitability of the business, also the ability of the company to earn profits and also bear the expenses. So what is actually the return of investment, the gross profit ratio and net profit ratio will explain this category. Then comes the turnover ratio. So turnover ratio is like the asset turnover ratio, inventory turnover ratio. This determines how the business is able to use its available resources to generate profit. Okay. So we will now go to the formulas. Like the liquidity ratio, the most common is the current ratio. That is current asset divided by current liabilities. And quick ratio is liquid assets divided by current liabilities. So how is current assets and liquid assets different? Liquid assets is current asset minus the inventory, the prepaid expenses and the advance tax. Okay, and the ideal ratio for current ratio is 2:1 and for quick ratio it is 1:1. Okay. Now comes the solvency ratio, that is debt equity ratio. This is equal to long-term debts divided by shareholders fund. The ideal ratio for this is also 2:1. That means more funds are invested by long-term lenders. Okay, so long-term debts are more lenders have invested in the business compared to shareholders fund. Then total assets to debt ratio, total assets divided by long-term debts, that is extent to which the total debts are covered by the assets of the company. This ratio will suggest this thing. Then comes the proprietary ratio, that is shareholders fund by total asset. That is high ratio means a sound financial condition. That means the large portion of asset is provided by equity. Right? So less dependence on external finance. Interest coverage ratio is profit before interest and tax divided by interest charges. This reveals the number of times the interest on long-term debts is covered by profits available. So high ratio ensures safety of interest on long-term debts. Now comes the turnover ratio. These are also very famous. This is inventory turnover, means cost of goods sold divided by average inventory. When inventory, whether this inventory is properly used or not. That is, higher means inventory is selling quickly. Right? So cost of goods sold is what? You know the formula. It's opening stock plus purchases plus the direct expenses less closing stock. And average inventory is the average of opening inventory plus closing inventory divided by 2, that brings the average. Debtor turnover ratio, that is debtors plus bills receivable divided by average daily credit sales. So what is the formula for calculating the average daily credit sales? It is credit sales divided by 365 days. So this indicates the speed with which the amount is collected from the debtors or from bills receivable. Okay. Creditor turnover ratio, that this is also creditors plus bills payable divided by average credit purchase per day. The same formula for calculating the credit purchase, that is credit purchases divided by 365 days or 360 days. And this also shows the speed with which the amount can be paid off to the creditors. Fixed asset turnover ratio is net sales divided by fixed assets. Net fixed asset. This indicates how efficiently fixed assets are utilized in generating the sales. Working capital turnover ratio, that is equal to net sales divided by working capital. Working capital means current asset minus current liabilities. So how efficiently the working capital is being used to generate the revenue. Profitability ratios are gross profit divided by turnover ratio, net profit is net profit by turnover, and return of investment is net profit before interest, tax and dividends divided by the capital that is employed. Okay, so let's do one illustration which will help us understand the different ratios. See, the following trading and profit and loss account of Ganpati Garments Limited for 31st March, for the year 31st March 2024 is given below. Calculate the GP ratio, expenses ratio, operating ratio, net profit ratio, operating profit ratio and stock turnover ratio. So let us see what are the things that are given. This is opening stock, purchases 3,15,250, carriage and freight, wages. These are the direct expenses. And then gross profit, closing sales and closing stock. Okay, gross profit is 2 lakh. Then comes administrative expenses, selling and distribution expenses. These are the operating expenses, 1 lakh 1,000 and 12,000. Non-operating expenses are 2,000 and financial expenses 7,000. Now this side, non-operating incomes. Apart from sales, the income are non-operating income, that is interest on securities, dividend on shares and profit on sale of shares. Then finally comes the net profit. Okay, so let's solve this problem. First, we are going to find out the gross profit ratio. So gross profit is 2 lakh. Gross profit ratio is gross profit divided by turnover. So gross profit is 2 lakh by 5 lakh. Let's see. Gross profit margin is divided by sales into 100, 2 lakh by 5 lakh into 100, that is 40%. Now, expenses ratio. So, expenses ratio will be, expenses are, these are the operating expenses. So, operating expenses divided by net sales into 100. So, let us see what are the operating expenses. 1 lakh 1,000 plus selling and distribution 12,000. That makes it 1 lakh 13,000. 1 lakh 13,000 divided by 5 lakh into 100. This is the expense ratio. Now the net profit ratio. So net profit is 84,000 divided by 5 lakh. It's very simple. Now comes the operating ratio. So what is operating ratio? The formula will be the cost of goods sold plus operating expenses divided by net sales. So cost of goods sold, we can calculate this. This is opening stock plus purchases plus the direct expenses minus closing stock. So opening stock 76,000 plus purchases 3,15,000 plus carriage and freight 2,000, wages 5,000 less closing stock. This will be the cost of goods sold. This comes to 3 lakh round figure. Okay, fine. Then the operating expenses we have already calculated. 1 lakh 1,000 plus 12,000 is 13,000 and the sales is 5 lakh. So 3 lakh cost of goods sold plus 1 lakh 13,000 divided by 5 lakh. This brings it, this is equal to 82.6%. This is the operating ratio. Now, operating profit ratio. This is only the operating expenses ratio. Now, the operating profit will be sales minus cost of goods sold plus operating expenses. These are the expenses. So, if you deduct this from the sales, you will get the operating profit. So, that will come to, this is 4 lakh 13,000. So, if you deduct it from sales, 5 lakh minus 4 lakh 13,000 is 87,000. So, 87 by 5 lakh is the operating profit ratio. Now comes to stock turnover ratio. This is cost of goods sold by average stock. You should refer to the formula. You should have the formula in front of you. You write it down. I think you should all maintain a formula copy where your formula should be written so that it's easily accessible also. Okay, so stock turnover is cost of goods sold. We have already calculated cost of goods sold 3 lakh, and average stock. Average stock is 76,250 plus 98,500 divided by 2. Okay.